Stop everything for a moment, because the silver market is sending a warning signal that almost no one in mainstream finance wants you to see. Not next week, not sometime later this year, right now. And if you miss what's happening, you're going to wake up one morning wondering why the price moved without you. The reason behind it all will leave you speechless. As this is being recorded, it's Sunday, February 1st, exactly 12 more noon, New York time. Before going any further, drop a comment with the time you're watching this. It's always fascinating to see just how global this community has become. A quick note, there are now over 1,000 members who receive daily members-only videos and early access to every piece of content on this channel. They stay completely updated with every market shift. If staying ahead sounds valuable, consider joining. The link is in the description, or just tap the join button below. It takes less than 30 seconds. Also, check the description after watching because there are bonus links waiting, including a premium WhatsApp channel and a membership join link. Now, here's the headline that people are whispering about, but very few are saying out loud. China has been purchasing massive quantities of silver, and the local price inside China has been trading at a premium that makes the global market look completely broken. But the real question isn't whether China bought. The real question is, why are they buying so aggressively, and what happens if their next move isn't just about industrial demand, but something monetary? Because there's a rumor that keeps coming back every time currencies start looking shaky. What if they back the yuan with something real? Now, that's not guaranteed. In fact, the oversimplified version of that story will be challenged in a moment, but here's what cannot be ignored. When a country starts vacuuming up a strategic metal, and the price inside its own borders disconnects from the rest of the world, that's not something to brush aside, that's something to zoom in on. That's when smart observers start asking, who's desperate, who's cornered, and who's quietly preparing for what comes next? Let's talk about what most people have already noticed. Silver has been moving like it swallowed 3 energy drinks and decided to fight gravity. Big surges upward, sudden drops, then another push higher, and every single time this happens, the same cycle repeats. Someone posts a chart, slaps a dramatic headline on it, and declares the entire run is finished. That's it, the peak. Sell now before losing everything. You've seen it. Everyone has. And the funny part? The market doesn't care about their certainty. Here's what actually matters. Not the drama, but the structure underneath. When a market truly tops out, it doesn't just become volatile. It loses its buyers, rallies get sold hard, support disappears. But when a market is being driven by real-world demand, volatility can exist while a floor remains underneath. Actual users and actual accumulators show up on every dip, like it's a clearance sale they've been waiting for. So when looking at the past few weeks, the better question isn't whether the price swung wildly. The better question is, did it break? And for silver, the answer so far is no. Every hit has found buyers faster than the pessimists expected. That's the first clue. Now, here's the second clue. Pay attention to the stories being pushed to explain the swings. This is where staying alert matters most. There's always a neat little narrative offered right when emotions are running hot. An index gets rebalanced. A fund rolls its positions. Some big institution adjusts its weightings. And suddenly the message becomes, brace yourself because a tidal wave of selling is coming. Let's be clear about something. Scheduled money flows can move markets in the short term. That's real. But what happens every single time is that the narrative gets turned into a weapon. It gets used like a megaphone to frighten the exact people who always buy at the wrong time and sell at the wrong time. The story becomes bigger than the actual event. The event is a pebble. The story is a boulder thrown directly at your confidence. And here's the trick to remember. When a warning sounds urgent, ask yourself, urgent for who? If the warning is everywhere, if it's aimed at regular investors, if it's delivered with that smug certainty, it usually isn't for protection. It's designed to shape behavior. Here's something most investors never think about. When someone buys silver through a screen, clicking a button, watching numbers change, that's not the same as holding the metal, not even close, because when regular people start buying physical silver, something shifts in the entire system. That metal, once it leaves the vault, is no longer sitting inside someone else's game. It's not earning them a fee. It's not being lent out and borrowed again. It's not a number on a screen that can be multiplied with leverage. It's a real object, something that must be sourced, moved, and delivered. And when enough people do that, the whole paper structure starts feeling uncomfortable. That's why the warnings keep coming. That's why every dip brings headlines about selling pressure, about inevitable corrections, about how the smart money is exiting. Risk should always be respected, but other people's fear campaigns should never become your financial strategy. Now let's get into the China piece. Because this is where things get truly interesting. There's a detail that helps explain why this situation isn't just hype. Silver carries a deep monetary memory in China. For centuries, it wasn't gold that everyday people used, it was silver. Silver was the money of merchants, of workers, of families saving for the future. That cultural connection to silver as a store of value doesn't just vanish because the financial system modernized. It stays in the collective memory. Add to that the industrial reality of today. Silver remains a critical conductor in high-end electronics. It's used across energy systems where performance cannot be compromised. Solar panels need it, electric vehicles need it, 5G infrastructure needs it, data centers need it. According to the latest publicly available trade data, silver-bearing concentrates and refined metal flowing into China have stayed elevated, even as other imports cooled down. That's not panic buying, that's planning. When a buyer behaves like that, consistently, quietly, regardless of price noise, they're securing continuity. They're building a stockpile that doesn't depend on anyone else's goodwill, and this is exactly why the premium matters so much. Inside China right now, the domestic silver price has been trading above the international price, not by a little, by a premium that is not normal. When you see a gap like that, it's basically the market screaming one message: we want the metal here, not paper claims, not promises, the actual metal. That premium acts like a magnet. It pulls physical supply toward China. It creates opportunities for traders willing to move metal across borders. And it tells anyone paying attention there's a serious mismatch happening. What people can click and buy in Western markets is not the same as what people are willing to pay where the metal actually needs to land. Based on recently published numbers, physical demand inside China has been intense. Local pricing has repeatedly signaled tightness, and this isn't just investment demand driving the pressure. A massive portion of silver consumption is industrial, electronics, power systems, soldering, chemical applications, and yes, solar manufacturing on a scale the world has never seen before. Silver is not a shiny collectible sitting in a display case. It's a utility metal that happens to have a history as money. But here's the twist that most people completely miss. Industrial demand doesn't need to be growing wildly for the price to explode. Industrial demand just needs to be stubborn. Think about it. If the world has already built systems that require silver, factories, power grids, production lines, supply chains, and if the supply of silver cannot respond quickly, then you get a squeeze. Not because everyone suddenly wants more, but because the existing demand cannot be turned off and the supply cannot catch up fast enough. Now add investment demand on top of that foundation, people buying coins, bars, ETFs backed by real metal, and the market can move faster than logic would predict because the supply chain is slow, because mines take years to develop, because most silver is produced as a byproduct of mining other metals, and because the paper market is leveraged far beyond what the physical market can deliver. This is where things get uncomfortable for certain players. When paper promises stack up and physical availability tightens, the system doesn't adjust smoothly, it adjusts suddenly. One day everything looks normal, the next day, the price gaps, and everyone pretends they saw it coming. That's not conspiracy, that's just how tight markets behave when stress finally arrives. So the question worth asking isn't whether silver will be volatile. Of course it will be. The question is, what's underneath the volatility? Is it pure speculation, ready to collapse at the first sign of trouble, or is it real tightness, where every dip gets bought because users and accumulators need the metal? So far, the evidence points towards the second answer, and that changes everything about how to think about what comes next. Most people think about money the wrong way. They see a currency and assume strong means stable, but that's not how it works. A currency can remain dominant, can be used everywhere, can settle trillions in trade every single day, and still lose purchasing power. Slowly, quietly, year after year. Dominance and value are not the same thing. The dollar is strong against other currencies, but strong against what else? Against groceries, against rent, against energy bills, against the cost of building a life? Most people don't live inside currency pairs on a trading screen. They live in the real world, where prices keep climbing and paychecks keep shrinking in what they can actually buy. That's the game nobody talks about on financial television. That's the slow bleed that empties wallets while the headlines celebrate strength. Now connect this to what China is doing. If China wants to reduce its dependence on the dollar system, it doesn't need to destroy the dollar overnight. That's not how this game works. It just needs to build options, layer by layer, quietly, the ability to settle trade in different units. The ability to hold reserves in different forms, the ability to reduce exposure to choke points that someone else controls. Because the dollar system isn't just about currency, it's about settlement rails, it's about payment messaging, it's about sanctions risk, it's about the power to freeze, to block, to cut off access with a single decision from Washington. If you're a major economy and you don't like that vulnerability, you diversify, you build alternatives, you hold assets that aren't someone else's liability. And silver, historically, has been exactly that kind of asset. It's not tied to one government, it's not a promise to pay, it's a thing, a real, physical thing. Now here's where most videos get it wrong. They hear China is buying silver and immediately jump to the fantasy version. They're going to back the yuan with silver, they're going to announce a new monetary system. The dollar is finished by next Tuesday. Slow down. Backing a currency with a metal is not like flipping a light switch. It requires credibility, it requires transparency, it requires redemption mechanisms that people actually trust, and most importantly, it requires a willingness to lose control over the money supply. Governments don't like losing that control. They like the ability to stimulate when things slow down. They like the ability to bail out when things break. They like the ability to print their way through problems. Metal backing is discipline, and discipline is politically expensive, so the meme version of a silver-backed yuan deserves heavy skepticism, not because it's impossible in theory, but because in practice, it comes with trade-offs that most policymakers run away from. But here's what deserves serious attention. A country doesn't need to promise full convertibility to use silver strategically. They can stockpile without announcing it. They can encourage domestic ownership without making headlines. They can use metals in bilateral trade deals, settling with partners who also want dollar alternatives. They can treat silver like a strategic input, the same way they treat energy reserves and food stockpiles. None of that requires a dramatic press conference. None of that requires rewriting the global monetary system overnight. But all of it can still have massive market impact. So instead of asking the wrong question, will they back the yuan with silver? Ask the smarter question. Are they trying to reduce vulnerability to the dollar system? That's the real frame. That's what the accumulation is actually about, because when a country builds reserves in assets that cannot be frozen, cannot be sanctioned, cannot be deleted from a database, they're not predicting the future, they're preparing for it. And when preparation meets opportunity, that's when things move fast. Now bring gold into this picture, because you can't talk about monetary metals without addressing the elephant in the room. Gold has been in a long-term trend, where official buying from central banks has been meaningful. Every time the monthly numbers wobble, the same voices declare it's over. But when you zoom out, the pattern is clear. Reserve managers are diversifying. Currencies are being managed aggressively everywhere. Debt levels are staggering. Real purchasing power is getting squeezed. In that environment, institutions look for assets that don't depend on someone else's promise. That's not conspiracy, that's just basic incentives playing out. Gold keeps its role as the senior monetary metal, but silver is the wild card. It sits at the intersection of industry and money. It can behave like a boring commodity, then suddenly trade like a monetary asset when confidence cracks. And when that switch flips, the move can be violent because the market is smaller, because the inventories are thinner, because nobody was paying attention until it was too late. Here's something that will sound boring at first, but it might be the most important thing in this entire story. Real rates and liquidity. Stay with me, because this is where fortunes are made or lost, when the return on cash and bonds doesn't keep up with inflation. Something quiet happens. Savers start losing purchasing power, even while their account balances stay the same. It's like a hidden tax. The numbers look fine, but what those numbers can actually buy shrinks every single month. And when that happens for long enough, people start looking for alternatives, not all at once, gradually, one person at a time, one decision at a time. But once that shift begins, it feeds on itself. That environment is where hard assets come alive. Not because silver or gold are magic, but because the alternative is a guaranteed slow loss, and nobody wants to watch their future melt away while pretending everything is fine. Now let's talk about what happens when stress finally arrives. In normal times, the paper market leads. Traders set the price. Futures contracts move first. Physical metal just follows along like a quiet passenger. But in stress times, the relationship flips. Physical starts leading and paper has to chase. When that dynamic takes hold, the charts can move in ways that make people say the market is broken. Gaps appear. Prices jump overnight. The comfortable relationship between paper and metal falls apart. And here's the truth nobody wants to admit. Something did break. The assumption that the paper price reflects reality. The assumption that contracts backed by leverage are the same as metal you can hold in your hand. When physical tightness becomes severe enough, that assumption dies, and the repricing can feel deeply unfair to anyone caught on the wrong side. Now here's the scenario that keeps certain people awake at night. If the domestic premium in China persists, if global inventories that matter for delivery keep shrinking, if users and accumulators keep showing up on every dip, you could see a moment where the price discovered on trading screens becomes almost meaningless. The physical market takes control, and the paper market has no choice but to surrender. That's not a prediction. That's just what happens when promises outnumber reality by too wide a margin. Markets don't price that stress smoothly. They price it suddenly, and suddenly is what creates life-changing moves. But before getting too excited, a reality check is necessary. Markets can stay strange and volatile for longer than anyone expects. Hype can destroy portfolios if position sizing is wrong or if entries are chased at the worst possible moment. This is not a speech about going all in. This is a speech about paying attention and thinking clearly while others panic. The goal isn't to catch every tick. The goal is to stay in the game long enough to benefit when the thesis plays out. Hype gets clicks, but hype also gets people wrecked. Discipline is what separates survivors from casualties. Now here's the final cliffhanger, and it might surprise you. The most explosive moves in silver don't happen when everyone is excited. They happen when people get bored, when volatility shakes out the impatient, when the crowd declares it's over, when attention shifts somewhere else. That's when the market rips higher, because the underlying tightness never left. It was just ignored. The metal kept disappearing into strong hands. The premium stayed elevated in places that actually take delivery. The paper sellers kept selling, until one day, there was nothing left to sell. And then, the price moved without most people on board. That's the move that feels unfair. That's the move that makes latecomers say the game is rigged. And maybe it is rigged, just not always in the direction they expected. So here's what actually matters going forward. Watch the premiums, watch the delivery signals, watch how dips get bought or don't. And most importantly, don't let loud voices on the internet trade your account for you. The people screaming the loudest usually have the least to lose. The people accumulating quietly usually understand something the crowd hasn't figured out yet. Decide which group you want to belong to. If this breakdown provided value, drop a comment with the time you're watching. Share the one thing you're watching most closely in silver right now. Is it industrial demand, currency strategy, or something nobody is talking about yet? The conversation continues in the next one. And as always, a quick important reminder, everything shared here is for education and discussion only. This is not financial advice. Situations vary. Nobody can tell you exactly what to do with your money. Do your own homework, think for yourself, and stay prepared for the move that most people will miss.